Joining us to talk about the market today, Jeff Saut is here from Capital Wealth Planning. Charlie Bobrinskoy still with us from Ariel Investments. First, though, Mike, on the action that we saw today and what it tells you.
Markets relaxed a little bit. I think Friday, the stock market drop kind of front-loaded a lot of concern about what Asia would look like when China opened up again. And I think that it was not quite as bad as feared. Also, it probably takes a little incremental bad news on the coronavirus side to get things kind of shuttling lower once we got a little bit oversold Friday. That being said, we're just kind of in no man's land right here. You know, you had a 3+% pullback in the S&P. We bobbed back up to a level basically where we started the year, and I think it's kind of sideways as we wait for the results of Iowa and obviously, you know, brace for anything else on the China front.
Jeff, where do you stand in terms of the size of that pullback? We said, as Mike said, 3% or so. Was that enough to get bullish again?
Well, it was like 3.6%, and I think Bob Pisani had it right. You had two 80% downside days, meaning that 80% of the up to down volume came in on the downside, and 80% of the total points traded came in on the negative side. So what you've got here is an oversold throwback rally. And my friend Mike Santoli's got it right. I think you're in no man's land. The internals today are not all that bullish. So I think it's a wait-and-see market on a short-term trading basis. On a long-term basis, we're still in a secular bull market that has probably another 5 to 10 years left on the upside.
You know, China was a big fact. Wow, that's a long call. 8% down day in Chinese stocks, Charlie. China did step in. They had a surprise rate cut on repurchasing repos. That's how they do it, basically. They infused a ton of liquidity into the system. What else are you watching out of the Chinese authorities that would make you more confident with this market?
Unfortunately, I think it's the biology. I think we have to see how virulent this strain is. We're all saying that the past SARS behavior was relatively easy to get behind us. Other scares have been manageable. But if you go back in history, there are things like malaria that had a huge impact for a long period of time. And so I'm going to go back to where I started this whole program. I know what I don't know, and I don't know how serious this is going to be.
Mike, what do you make of the move in yields? Clearly, again, we've seen a bigger rebound to the upside in stocks than we have on yields. It sort of paints a picture of some more severe risk aversion that perhaps hasn't infected the equity market yet.
Risk aversion, also just this kind of short-term disinflationary impulse. Obviously, we have to kind of revisit whatever you thought the global growth numbers were going to look like for the first quarter anyway. So to me, that's what it tells you. And we're not easily freed up from that sort of late cycle thinking that any little shock is somehow going to knock us back into a direction of toward the zero line for growth. I'm not sure that's the case, but I do think that's where the market kind of rushes to on a reflex basis.